The Minority Market. Episode 75. Mistakes most traders repeat every cycle. Every market cycle creates a new group of hopeful participants. New investors enter with excitement, confidence, and expectations of fast profits. And every cycle, the same mistakes are repeated again and again. Technology changes, platforms evolve, tools improve, but human behavior remains the same. This is why the majority keeps losing while the minority keeps surviving. The first repeated mistake is chasing performance. When a stock or sector is already trending strongly, beginners rush in late. They buy near tops, driven by excitement and social proof. They see others making money and assume the opportunity is still fresh. In reality, by the time something becomes popular, most of the easy gains are already gone. The minority understands that opportunity is created before hype, not after it. Another major mistake is trading without a plan. Most traders enter positions without knowing where they will exit, how much they are willing to lose, or what conditions would invalidate their idea. They rely on hope instead of structure. When the trade goes wrong, confusion takes over. Panic decisions replace logical ones. The minority never enters blindly. They define risk first, profit second. Overtrading is another cycle-driven error. During volatile markets, people feel the urge to trade constantly. They believe more activity equals more profit. In reality, more activity often leads to more mistakes. Fatigue, emotional exhaustion, and reduced focus destroy discipline. The minority knows that selective participation creates better results than constant action. Ignoring risk management destroys more accounts than bad strategies ever will. Many beginners focus only on how much they can make. They rarely calculate how much they can lose. They use oversized positions, excessive leverage, and poor stop placement. One bad move wipes out months of effort. The minority protects capital first. Survival is the foundation of long-term success. Another repeating mistake is emotional attachment to positions. Traders fall in love with stocks. They defend bad decisions instead of accepting reality. When price moves against them, they hold on longer than planned, hoping the market will reverse. Hope is not a strategy. The minority remains flexible. They accept when they are wrong and move on quickly. Chasing news is another trap. Every cycle brings dramatic headlines, predictions, and market narratives. Beginners react emotionally to breaking news without understanding how markets already priced information. They buy on good news and sell on bad news, usually at the worst possible time. The minority observes price behavior, not emotional headlines. Many traders repeat the mistake of constantly changing strategies. When something does not work immediately, they jump to another system. They never stay long enough to develop mastery. They move from indicator to indicator, from method to method, searching for perfection. The minority commits to learning deeply instead of switching endlessly. Another common error is unrealistic expectations. Social media creates the illusion that everyone is making massive profits quickly. Beginners expect fast success and become frustrated when results take time. This impatience leads to reckless risk-taking and emotional decisions. The minority understands that compounding requires time, consistency, and discipline. Lack of self-awareness also causes repeated failure. Traders blame the market, brokers, news, or algorithms for losses. They rarely analyze their own behavior. Without reflection, mistakes repeat. The minority journals trades, reviews decisions, and identifies emotional patterns. Market cycles also amplify herd behavior. When prices rise, optimism spreads rapidly. When prices fall, fear becomes contagious. Most people move with the crowd. The minority resists emotional waves. They act based on preparation, not mass emotion. Another repeating mistake is neglecting personal psychology. Traders spend years studying charts but ignore emotional control. Fear, greed, revenge trading, and overconfidence destroy consistency. Without emotional discipline, technical knowledge becomes useless. The minority trains the mind as seriously as the strategy. Failure to adapt is another cycle-driven problem. Markets evolve. Conditions change. What worked in one environment may fail in another. Beginners either blindly stick to outdated methods or randomly jump to new ones. The minority adapts thoughtfully, testing changes slowly and systematically. Many traders also misunderstand drawdowns. Loss periods are normal. Beginners interpret drawdowns as personal failure and abandon their approach prematurely. The minority understands that drawdowns are part of probability-based systems. They stay disciplined during difficult periods. Another critical mistake is ignoring long-term thinking. Most traders focus on daily profits instead of building sustainable systems. Short-term excitement replaces long-term growth. The minority builds processes designed to survive multiple market cycles. The final repeated mistake is ego. Traders want to be right more than they want to be profitable. They argue with charts, defend opinions, and refuse to exit bad positions. Ego creates blindness. The minority values results over pride. Breaking this cycle requires awareness. When you recognize these repeating patterns, you gain power over them. The goal is not perfection. The goal is consistency and improvement. Ask yourself honestly, do you chase hype? Do you overtrade? Do you react emotionally? Do you ignore risk? Every honest answer moves you closer to the minority mindset. Markets will continue to repeat cycles. The same traps will continue to exist. The question is not whether the cycle will repeat. It is whether you will repeat your mistakes or rise above them. Those who learn from past cycles build resilience. They stop making emotional decisions. They focus on discipline, structure, and patience. The minority does not rely on luck. They rely on preparation. They do not react to noise. They respond to structure. They do not chase outcomes. They protect process. And this is how long-term survivors are created.